Greetings, everyone. Scott Richardson with Dan Brown from Richardson Capital Management. We're here to present the May 2021 Investment and Economic Update. April was a busy month, and we've got a lot to cover, so I'm going to jump right into it. We're going to start with the fact that the financial markets performed very favorably during the month. We had widespread gains among all the asset classes, and actually all 11 economic sectors were positive for the month as well. U.S. large cap stocks led the way, but small cap U.S. stocks and international stocks were also nicely positive. And fixed income was positive for the month, which was a change as fixed income had been producing negative returns in January, February, and March as interest rates had been increasing rather rapidly during that period. So the key takeaway is the fact that the financial markets performed very favorably. Now, there was a lot of economic data that helped support that growth, and a couple of the key items were the gross domestic product report that came out, as well as some employment numbers. And with that, I'm going to turn it over to Dan.
Thanks, Scott. Labor markets are recovering very rapidly as the economy reopens, as the vaccination program for the COVID-19 is going very well. So we saw employers add 916,000 workers to payrolls with the most recent report. And we think for the next couple of months, it's very possible that employers add 1 million plus workers for the next couple months. And then we're also looking at weekly unemployment claims, which are at a pandemic low. So very positive signals coming from the labor market. And then for GDP, we saw first quarter GDP reported late in the month. It came in at a pretty robust 6.4% annualized rate. That was slightly less than expectations. There are many estimates out there for 8%. And if we look at the components of GDP, consumer spending, which is the largest component of GDP, was very robust. Again, as the economy reopens, consumers are eager to spend, and they're also flush with savings from all the direct payments that have come from the government. The one negative for GDP that we saw was inventory destocking occurring during the quarter, as there's some notable shortages and supply chain issues. One of those issues that you might have heard of is the shortage of semiconductor chips. But again, we expect that for the next couple quarters, that we could see annualized growth approaching 10% for the second quarter and third quarter. And Scott, over to you, because I think you've got an update for us on housing.
We've got a lot of demand for single-family housing at this point, driven in part due to the fact that there's a lot of individuals looking to leave urban areas and move to more suburban areas. And secondly, we've got the extremely low interest rate environment, which is making it very cost-effective to own a single-family home. One of the issues we're dealing with is the fact that there's a relatively limited supply of homes at this point. The impact of that is the fact that prices have been going up for housing. However, this should create a lot of demand for construction of single-family homes, which should be supportive for the economy. On this note, it was interesting to note last week when the Federal Reserve met that they brought this point up about the housing shortage and the fact that it may cause some transitory impacts to inflation and costs. With regard to the Federal Reserve and their recent meeting, they indicated they're going to remain very accommodative and they're going to keep interest rates low and continue their bond buying program for the indefinite future. Let's shift gears and talk a little bit about some of the fiscal policies and some of the tax proposals that have been brought up recently. And with that, I'll turn it over to Dan.
Thanks, Scott. So we saw two proposals and details from the Biden administration in April. The first plan that was proposed is called the American Jobs Plan, and it proposes to spend about $2.25 trillion on traditional infrastructure projects like roads, airports, rails, water, etc. And this would be paid for primarily through higher taxes on corporations. The second plan is called the American Families Plan, and that proposes to spend about $1.8 trillion on more social programs like education and family leave and some green energy initiatives. And that would be paid for through higher taxes, primarily through higher capital gain taxes on the top earning individuals. We think both plans will eventually be watered down, and as far as the timing of the first bill, we're probably looking at sometime in the fall, maybe right after the August recess. So we're evaluating both these plans and what their impact could be on the financial markets in the future.
And so to wrap things up, we still feel very constructive on the economy and the financial markets due to all the things we talked about earlier. Federal Reserve remaining accommodative, vaccines rolling out, employment looking strong. Now we'll need to be very cognizant of the fact that there's concerns regarding inflation and there's going to be concerns regarding the tax plan coming out. So as a result, we'll probably have some volatility moving forward. But that said, we still think the economy and the financial markets should move forward, and we feel very constructive. I want to thank you all for joining us. And as always, if anyone has any questions or concerns, please don't hesitate to reach out to us. Thank you.